welcome to the channel. DRSN here. Basketball isn't the only game where scoring matters. In today's video, I'll explain credit, define lines of credit, what is a credit report, a credit score, and 5 factors that impact your credit score. The terms, notes, and definitions come from this book, How to Adult by Jake Cuisine. So let's get started. What is credit? So where credit is where a borrower, someone who borrows money, who receives money, or goods or services, he receives it from a lender and he commits to repaying that lender at a later date. Is you essentially being in this situation, essentially you're the borrower and you're receiving money, which is credit, but you're gonna have to pay that money back in a later date. So that money borrowing instance is known as a line of credit. So in other words, when you borrow money for a purchase, because you can't pay the total price for that good, product, or service at the moment, you are opening essentially a line of credit. I'm gonna give you some examples right now. So mortgage is an example of line of credit because you're borrowing money. You're borrowing money to buy the house. You didn't pay off the house, but you still have access to your home. You get your house keys. You can live in your house. In terms of a mortgage, so you'll pay monthly payments to complete your house payment. Another example is student loans. So you're borrowing money to pay for school, pay for college. Auto loans. So you're borrowing money to pay for your car. And a famous example is a credit card. So you're borrowing money to pay whatever you bought with your credit card. Average American has 4 credit cards. So you might ask, why do you need to borrow money? So when you buy a home, let's say a home costs $500,000, you don't have that money on you. Not typical American won't have $500,000 with them, so they'll make a down payment of $100,000, and then they'll borrow the remaining $400,000 from a lender, typically a bank, and then over the next 10 to 20, even most likely 30 years, the home buyer will be paying that $400,000 back in terms of monthly payment plus interest. So if you haven't watched my video, I made a video on interest too. You can watch that where I explain that. So an average American has 5 to 7 lines of credit open to them at one time. Having debt is not a bad thing because you might need it. So you might need, for example, you might need a vehicle to get to work or get to school. So having debt is not always bad. Some of these, like having a vehicle, may be necessary for you. It's not a luxury. So let's explain what is a credit report. A credit report shows your history for a line of credit. A line of credit, just for review, is a money borrowing instance. It shows your history, shows whether you paid your debt on time, made your monthly credit payment on time. So consider your credit report, or consider more of a credit history as a list of assignments for a class, as an analogy. This is an example of a credit report. So the account name's on the top left. Account number, so the person's name is Mike Hick. That's their account number. The recent balance, their address where they live, the type. So the line of credit is a credit card. That's the date the credit card was this account was open. So when the credit card was in use, starting in November 2016. High balance, credit limit. So what is credit limit? Credit limit is the maximum money a credit card issuer allows you to borrow at a given time. So the max amount of limit that you could use. So in this example, a monthly this person, my kid, could only use $5,000 credit per month. What's high balance? So high balance is the highest amount of debt you historically owe. So it's the largest amount of money you borrowed. This lets the money lender, know how heavily you're using your credit. So now let's look at account history. Each month, there's either OK or 30 or 60. So OK in your account history, so status is open, so your credit card is working. But OK means that the account holder, my kick, he paid off his credit debt. He paid off the minimum payment for that month. So OK, you want OK. OK is a good sign. You want that. In February 2020 and March 2020 is where the credit problem occurs. The 30 represents that my kick was 30 days late on paying off his debt here. And then on March 2020, the 60 represents that my kick was 60 days late in paying off his debt. Couple of months of not paying off your debt could hurt your credit score. We'll go over what credit score is in the next slide. But what you want to know about a credit report is essentially represents one line of credit. In this example, is a credit card. It gives your status in terms of if you're making your debt payments, your credit payments, monthly payments. If you're making your monthly payments, you have an OK sign. If you don't put your monthly payments, they stack up. So it stacked up here February. There's 30 days late. You didn't pay. Then in March 2020, you didn't pay again. So 60 is stacked up. And this will hurt my kick's credit score. But let's define credit score right now. What is a credit score? Credit score, also known as a FICO score. So score is considered like your final grade. So a credit report I mentioned before was a list of assignments in a class as an analogy. So your credit score is more like your final grade. This is a grade that you get for paying off your debts. So if you pay off your debts on time, you pay off your credit on time, you have a high score. If you don't, you get a low score. So 3 bureau government departments, they create this score, they calculate it for you. Those are FICO, which is Fair Isaac Corporation, Experian, and Equifax. This range determines what interest rates you will get when you open new lines of credit. So as I mentioned before, if you have bad credit score in the 300-400 range, you're going to get high interest rates. You're not going to, which is something that you don't want. If your FICO score is high, you get a low interest rate loan, which is good. That's what you want. And to add on more to your FICO score, when I mean interest rate, I also mean APR, annual percentage rate. It's just another way of saying it. So now let's look at 5 factors that determine your credit score. So factor number 1 is credit history. So my advice here is don't have frequency of missing your payments, your credit payments. How long you missed your payments and how late your payments are also affect your credit score. So let me give you an example. If you currently have a line of credit where a bill is 90 days late, it's 90 days overdue, it's going to hurt your score more than a payment that was only 30 days late and it occurred 5 years ago. So the when matters and the where. So was it a long time ago or was it recent? And how long was the payment? How long is the payment late? So for number 2 is amounts owed. How much credit is available to you and how much are you using of your credit? For instance, a company gives you a credit card. Let's say they give you a credit card for $15,000 limit, monthly limit. But you don't want to be in a situation where you constantly use $14,000 of that credit limit. And my advice here is use below 30% of your limit. So in this case, you use $4,500 or less. Use 30% below the limit. You don't want you could say this is that you don't want to be spending a much of your credit. So some scorings, they look at your ratio between how much credit you have had made available to you and how much the credit you've used. So don't use close to the limit. Even when certain credit cards you use a lot, they'll give you a warning email or a warning phone notification saying that you're near the credit limit. So you don't want to go above the credit limit or even go near it. Based on the book, it says you should use 30% less. So length of your credit history means that a person who has a line of credit for 5 years, he's going to be much more reliable than a person who just has a line of credit for open only for 6 months. But don't constantly open and close accounts unless there's like high fees. So let me give you an example. If you have a credit card and it has a monthly fees are high, then you might want, and you're not using the credit card, then you might want to close that credit card, because you're spending a lot of money and you're not using it either. In terms of number 4, new credit. Your score also depends on how many new accounts you have applied for and how many you have. Applying for too many new accounts and having a lot of new accounts open is going to hurt your credit score. So you want to have ideally 5 to 7 lines of credit. Even if you're like a young adult, you probably might not have much lines of credit, which is okay. So for number 5, it's the types of credit in use, which is 10%, is whether you want a mix of different types of credit. So such as credit cards, store accounts, auto loans, and mortgages. It also looks at how many total accounts you have. Since this is a small component of your score, is 10%, don't worry. If you don't have accounts in each of these categories, and it's not end of the world, and don't open new accounts or don't open new lines of credit, just increase your credit type diversity. I'll say use a line of credit when it's necessary, like you have to pay off your student loan or you have to buy a car because you need it for transportation. Then it's a necessity, so you may need it. So then when you would open a line of credit, don't just open a line of credit because you want to diversify your credit. It's only 10%, so it's not a big deal. I'm going to give you an example here, credit scores and borrowing money example. This is from the book. So let's assume there's 3 people, Zaria, Vivian, and Paige. They're both 30 years old. They both want to buy a used car. Zaria's credit history is bad, she has missing payments, frequently missing credit payments. Vivian has missed only a few payments, and let's say Paige has no missed payments. All 3 of them are borrowing a car, so they're buying a used car, so they're going to borrow $20,000, let's assume, plus interest. And all 3, their plan is to pay it off in 60 months or in 5 years. So you can see here, because Zaria didn't pay her bills, her credit score is 580, so it's low. And because of that, she's paying a high interest rate, which is bad. Because of that interest rate is high, she's paying $9,266 in interest. She's paying $29,000. She would be paying $29,000 in that 5-year span, which is not good. 580 is alright, but you want a credit score around 700 to 800 range. Vivian only missed a few payments. Her credit score is 640. Her interest rate is slightly lower, 10%, 10.34%. So she's paying $5,000 in interest, and her total payment in those 5 years will be $25,000. Paige, who has a good credit score, only got a 4% interest rate, which is good. The interest she's paying is $2,000, which is $22,000 and $287 in the 5-year span. So the whole point of this example is to show how your credit score, it can affect how much money you have to pay in the long run. You want a high credit score. Your high credit score means low interest rates. Low interest rates means low interest paid. Low interest paid means less money paid. towards your loan in the long term, which can help you. Let's talk about key takeaways. Your credit history is the history that shows all your past and present lines of credit. I mean, credit report is for one line of credit, but your history, so it shows all lines of credits. It demonstrates how reliable you are in paying back the money that you have borrowed, so paying back your debt. So consider your credit report like your list of assignments as a good analogy. Your credit score shows how reliable you are in paying back the money you borrowed. So your credit score is more like your final grade, between 300 to 850, and you want your grade. You want this credit score to be 700 to 800 range. And this is, the higher your credit score, the more likely you are to qualify for better interest rates. If you have a terrible credit score, you'll be offered terrible interest rates. Yeah, so you want to, as I mentioned in the previous slide, you want a higher credit score so you get better loans, so you have less payments to make in the long run if there's interest involved. You don't want a high interest rate. You're going to end up paying a lot more in the long run. So protect your credit score by paying your bills on time. A low credit score can cost you a lot of money, in the long run. So you want it to be high. My final takeaway is that if you're a young adult, you might not have a lot of lines of credit. Your only lines of credit might be your student loans. But as you get older, you're gonna have 5 to 7. Ideally, you're gonna have 5 to 7 lines of credit. So you're gonna have mortgage, auto loans for your car, which are essentially all interest. They all have interest involved. But my advice, the best advice, is to pay your credit. Don't miss on your payments. And that's it for this video. Thank you for watching.